Welcome to TheoTrade. This is Don Kaufman. It's March 2nd, 2019, and you are watching the TheoTrade Weekend Update. All right, we'll begin with a quick recap of the markets from this past week of trade, which can only be described as, well, massively unchanged. Listen, this is a fairly docile week of trade that we just passed through. Yes, the S&Ps were slightly higher. Yes, the Nasdaq was slightly higher. Nevertheless, okay, we're still trapped in what I would term some volatility compression. I'm going to talk about that here momentarily. Before we get into that, let's just make a couple of big, I think, bullet points of what we saw in this last week of trade. Again, let's get into it. Number one, economic data in this last week was all over the place. We had some really horrific, like car sales data, housing data not so good, but on the flip side, China actually later in the week had some decent data. Maybe they're not completely collapsing over there. Whatever you might believe, again, about the future of the economy, the data is ambiguous at best. And again, the economic data that's coming out right now, it's hard for any investor or trader to really wrap their arms around it or try to substantiate it in any way, shape, or form. And if you feel a little confused by that data, well, you should, because the marketplace was not really reacting to much of the data that was effectively coming out. So there's big data drops, obviously, before the market opens. And what did the market do? Nothing. As I said, it was kind of massively unchanged. This next week, this coming week, we actually have employment numbers coming out. But if we have any of the same, markets won't move. Another bullet point to be made. Let's talk about the Nasdaq for a second. The Nasdaq is on a tear to the upside. This is the longest win streak in the Nasdaq since 1999. Now, I'm not trying to draw any comparisons between the bubble of 99. Obviously, the Nasdaq peaked out in March of 2000. I'm not trying to draw comparisons. I'm just simply saying, what a win streak inside of the Nasdaq. Can we have at least one down week? Well, we'll talk about that here momentarily. Next bullet to be made. Talk of the town, interest rates. All right. Okay, bonds have started to sell off. And again, we'll show you that in a moment in the charts. The TNX, which happens to be the yield, the interest rate associated with the 10-year, has jumped to 2.75. Enough said on that point. Again, we'll make that point in the charts. All right, next thing we want to actually bring up, China. Why are we bringing up China? I don't know. Earlier in the week, okay, they had over a 5% rally in one trading session. Oh yeah, that just speaks, okay, of China, the Chinese government just opening up, I talk about this all the time, just opening up this immense fire hose, and they are spraying liquidity everywhere. China has got your back if you're not necessarily thinking the Fed has your back, but apparently China does have your back because they are flooding right now capital into their markets. I mean, they're just outright, they're buying stocks, they are flooding capital into every way, shape, or form to let's prop this thing up as long as we possibly can. Well, again, I don't want to put too much of a bias in there, but it does reek, again, of trying to prop up a marketplace that is in substantial trouble, or prop up an economy, if you will, that's in substantial trouble. All right, next point to be made. Earnings expectations. So one of the things that I'm looking at in the markets right now, if you're looking at the markets, you're watching them kind of grind a little bit higher, and we've come up to this 2,800 level in the S&Ps. And you have to realize, while the market has been rallying, earnings have been effectively deteriorating, okay? And you get this complete and utter, like, detachment, if you will. You're actually thinking to yourself as a trader or an investor, you're like, is the marketplace even paying attention, even listening to what's going on in some of these companies? A lot of firms that are guiding lower. As we said a moment ago, economic data is all over the place. I mean, listen, the one thing we know about economic data, it ain't all positive, right? So some of the earnings expectations, though, are deteriorating, and we're hearing more and more that we're going into an earnings recession of many of the companies inside of the S&P 500. So what gives? Well, the S&P just keeps right on running. I'm going to give you an explanation of why we believe that's going on here in just a moment. But with this idea of deteriorating earnings expectations comes the fear, Are they going to slow down buybacks? They haven't at this point in time, but it's absolutely a consideration, because how can a board substantiate, we're like, we should buy back billions of our stock. Don't worry, our earnings are down, but we're going to buy back billions of the stock to prop everything up. There's going to be, again, a little bit of a fiduciary responsibility of that board to maybe see the company through past buybacks. Again, I'll come to that in just a couple of minutes. And the last point to be made before we jump into some of the charts, some of the option chains, is what we term compression of volatility. And that happens to simply be that volatility is getting, again, squeezed tighter and tighter and tighter. And as a trader, how does this impact me? First and foremost, the types of trades that you are using in this marketplace, okay? What are you doing? If you're out there selling options premium is often deemed a high probability strategy. As we get more and more compressed volatility, I don't want to be on the sell side of options right now. Now, granted, I made my entire career as a premium seller. In the last couple of years, though, okay, the big returns are being on the buy side of premium. And this is something I've reiterated in a number of these kind of weekend updates, number of the evening videos that we do, and throughout the chats on TheoTrade. Right now is not a time, okay, to go out and do high probability. Now, again, I'm associating high probability strategies with what? Premium selling. Okay, because that's what high probability is. You're going out, you're selling iron condors. Oh, I want a 90% probability. 90% probability is only going to get you one place right now, and that is in serious, serious trouble. Okay, in this marketplace, as the volatility gets more and more compressed, the opportunity, okay, isn't to go after the compression. The opportunity is to go after volatility gets really, really compressed down, is to go after when it pops back out. Okay, now with that, we saw this trading week, VIX options just took off in terms of volume. There are buyers, big buyers of out-of-the-money options, specifically in the VIX. Again, I'll show you that here momentarily. Lots to talk about. We're going to look again a little bit of what we term the Fed Watch tool. We're going to look at a couple of these, what I would term low probability, high profitability strategies. With that, let's get to it. Let's look at a couple of charts, a few option chains. To the charts and trades we go. Let us start inside of the E-mini S&P 500 index futures. Why? Well, we're still trading right off of the 2811 gravity point. Again, for those of you that have kind of been tuned in, turned on for quite some time, we have mentioned very, very specific levels inside of the S&Ps. And of course, this past week we closed just off of the 2811. We did hit it earlier on in the trading week. We'll zoom into it right now. Again, if you need a little bit of a refresh on those gravity points, pause the screen right now, because there are those gravity points. As I zoom into it, again, we hit the gravity point earlier in the week. We faded, bounced right back up into it. So where does this really leave us in the overall marketplace? I'm actually going to I'm going to pull over to the spiders for just a moment, because I just think it's a little bit of a cleaner chart without all those gravity points drawn on it. Okay, bottom line right now, we are at the upper end, okay, of this kind of what we term the volatility box, or what I term a volatility channel. And at the upper end of this, this is where trade becomes a little bit precarious to want to continue to allocate. Now, allocation, well, it's everything. I mean, that's substantiating more trades, more risk, okay? The question is, do you want to really stack more risk over here, whether you're long or whether you're short? We're in a very, very challenging area. I mean, right now, okay, to get long, well, what are you going to do? You're going to go out and buy this thing right now? I mean, you have to get, again, very, very strategic about how you want to substantiate positions. Moreover, okay, if a trader wanted to turn around and get short at this particular level, well, we all realize we could pop to the upside of the volatility box and boom, you know, your short positions are going to get ripped apart. That's why we're going to go for, and we'll talk about this again in just a few minutes, a lower probability kind of trades that have high profitability. We're going to take a couple of lower probability shots, okay, given the fact that substantiating, again, capital at these levels is precarious at best not to mention all the economic data coming out that just piles on. There's some negative economic data. We should buy that. That's kind of the way you feel in the markets on a day-to-day basis. All right, enough said on that front. The next point that I want to make over here, because we have a lot of points I want to make before we get into some strategies, all right, happens to be on the Nasdaq. For this, I'm going to pull up the Qs as mentioned a moment ago. In the video portion, we've actually got the longest streak in the Nasdaq to the upside since 1999. Hey, it was worth a mention, right? I mean, this isn't like, mind-boggling for me. The Nasdaq is on a tear back to the upside. One of the things, though, I would like to elaborate upon with the Nasdaq tearing back to the upside is a kind of a quick comparison. Here is the QQQ versus the spiders versus the IWM, and the irony of this is that the Nasdaq, okay, and the Nasdaq is right here. Okay, that's where the bubble happens to be. The Nasdaq is, maybe mildly outperforming, and this is on a year-to-date basis, maybe mildly outperforming the spiders. But the big winner, who's the big winner? It happens to be the Russell. So again, although that data is pertinent, the reason I was mentioning it, the Nasdaq win streak since 1999, is because the Nasdaq right now, okay, kind of feels a little lackluster, like it's almost out of gas versus some of the other major index products on there. All right. Also mentioned earlier on in the video portion, I was talking about China. Now, for China, I prefer to pull up the FXI, which is the iShares Trust China. The reason I like to pull up the FXI, it's a tradable product. That's what's important to me. I could pull up actual Chinese markets. What good does it do to pull up the Shanghai exchange? It doesn't. All right, we want tradable, tangible products. And if you look at the open interest here in the FXI, it is very much there. Penny, bid offer spreads. It's where I want to be. A few things to be made, points to be made on the Chinese ETF front. One of the first thing that stands out is number one. Obviously, earlier this week it was a 5% kind of jump to the upside inside of Chinese markets. And we faded a little bit off that, nevertheless, still having a fairly stellar week. Okay, why am I even bothering bringing this up? Well, for trade opportunity, one of the trade opportunities in here, look how low the implied volatility is. You're getting 4 and 5% moves on a day basis, 1 day basis, and the implied volatility is 20%. Okay, I see opportunity in there. I see opportunity, again, whereby this marketplace is capable of making drastic moves, and yet the implied volatility doesn't feel, okay, like what? Like a 20% IV. I mean, look, if you look at the March options with 6 days to go, obviously here we are on a weekend, but there's about a dollar being priced in for movement, okay? Is this product capable of moving more than a dollar, okay, in basically a week's time? Well, let's take a look. Here was at 43.5. What did it do? It shot all the way to 45. This is a $1.50 move, and then reversed back down, all the way back down to 43.50 before rallying back up. I'd say the answer is absolutely. For those of you that are a little bit more experienced, how could you take advantage of this? Stuff like FXI, things like gamma scalping start to come back to mind. Gamma scalping, for those of you that are totally want to geek out, it's like buying a straddle, shaving portions of it off, getting long and short stock. It's intensive, but I'm telling you what, in stuff like FXI, okay, this really resonates with me. All right, so think about it again. For those of you that speak geek, think about gamma scalping. Again, there's a reason for me mentioning products like this. It has nothing to do with the 5% rally in FXI. It's everything to do with a marketplace that's compressing volatility, okay, but still reeks of instability. Think about that for a second. We're compressing volatility, and volatility is just ever and ever tighter ranges, and yet we reek of instability all over the place. Like, you don't have to look very far to see instability in a marketplace. I think China is first and foremost when it comes to that idea. Now, came to China a little bit. Let's actually cruise over and let's talk a little bit about the bonds before we go any further, okay? Bonds, if you're unfamiliar with the bonds, I have tendency to look at like the ZB, which is the 30-year U.S. Treasury bond futures. But if that's not your thing, you can look at the TLT. Okay, either way, all right, the bond markets have sold off substantially. And I got to tell you, from where I'm sitting right now, I'm not much of a market technician, but this doesn't look like it's going to stop. Right? And the further these go down, the higher this interest rate associated with it starts to pop back to the upside. It's going to be short-lived, tough to tell at this point. But again, here is the TNX popping back to what? 27.55. Again, 27.55. And that people is what's incredibly important right now. Now, with that, I actually want to show you a little bit of what I termed the CME, the Fed Watch tool. If you've never seen this before, well, this is a little bit shocking. Along the lines of interest rates, put the bonds aside for a second. Okay, I was talking about in the video portion a moment ago, just wild economic data. It's just all over the place. I mean, again, you got home sales. You're like, that's not good at all. But it doesn't matter because like Home Depot and Lowe's continue to climb. All right. Oh, I know those are home repair. All right. But again, there's like this big detachment, if you will, from some of the economic data that's coming out. So when things get detached like that, I have tendency to go back and use things like a CME Fed Watch tool. This is a Chicago Mercantile Exchange. They have this Fed Watch tool. This is the meeting probabilities. Again, if you've never seen it before, you're kind of in space trying to figure this out. But what it effectively means, this is where, all right, the rates are currently. And again, these are Fed Fund futures rates. That's where the rate currently is. And this happens to be the probability, okay, and the meeting. So if you look at like this is coming up, this March meeting, ooh, how exciting. We're only 18 days away from the next Fed meeting. Oh, I'm waiting for you, Jerome Powell. They're basically saying that there's a 98.7% probability that we keep rates effectively the same. That's it. That's all it says. There's a 1.3% probability that they bump them up. But as you start to go out in time, again, this was kind of the talk of the trading community this week. You start to go out in time, look all the way down below here. There's like an 84%, 85% probability, okay, that this is effectively, we're basically not going to move. I mean, it's saying that the interest rates are not going to move throughout the course of the year. Now, I'm all the way out, okay, to January of 2020. Now, why are traders talking about it? Because they're actually looking at the chances of a decrease in rates almost is the same as the increase in rates. That's interesting, of course, to say the least. Think about the instability that creates, again, in a marketplace. Yet at the exact same time, okay, traders love this because they're like, no, the Fed's got our back. Okay, look, the probability states it, all right? The chances of us decreasing rates, the same as of us increasing rates. I just wanted to bring this into perspective because, again, what it's saying right now is not only isn't the Fed, and again, these probabilities, what are they based on? Based on Fed Fund futures. This is a tradable, tangible product, okay? I don't want to hear like, what is a sentiment indicator? I don't care what people are voting. Right? I care if they're voting with their wallets. And in this particular case, they are. And what this effectively says, okay, first of all, they're not going to raise rates. Secondly, they may actually cut rates, a year from now. And that, okay, has a lot to do with, if you will, the S&Ps feeling supported throughout the course of this. Okay, the marketplace right now, again, kind of feels once again that the Fed is completely backstopping them. The problem is I'm not entirely sure myself if that's going to be relative, if that's going to hold relative. So again, this creates, if you will, and the reason I got to that Fed Watch tool, this creates, as we were saying, this kind of compression in volatility. Why? Because what it effectively means is the Fed, all right, is going to keep and central bankers throughout the world are still going to keep flooding, okay, money into the global economy. Period. That's what it means. I mean, you literally have economies right now that are printing money to turn around to buy some U.S. stocks. Ooh, you gotta love that. So again, we're getting this constant compression, this pressure down. Why? Because it's trillions of dollars right now seeking returns. And when you get this compression of volatility, it's not necessarily smart money. It's money doing anything it possibly can to seek the slightest amount, if you will, of alpha, and that's returns above the S&Ps. Okay, I take the kind of contrarian perspective on this. Why? When you start getting volatility compression, it just gets wound up, okay, like a little top, and eventually explodes. And this type of volatility compression, by the way, this is one of the fastest, okay, drops in the VIX ever recorded. This type of volatility compression will lead us to what we term low probability high profitability strategies where you want to take a shot. Stuff, and again, I've been reiterating this, stuff like risk twist spreads in the spiders or the SPX, stuff like, again, we talked about the Qs, right? Maybe risk twist spreads in the Qs, stuff where if the marketplace does go through another volatility shock, okay, you can be wildly profitable. All the meantime, I strongly suggest, as I was talking about in the side of the spiders, we're at the upper end of this volatility box. Okay, what kind of strategies you're going to substantiate up here? This is where you want to go out and you want to use things like in-out spreads, little bits of risk. Okay, if you would like to go out and use duration strategies, that's deep in the money puts, okay, to possibly take a couple of short positions here or there, I'm fine with it. Just recognize that you're substantiating risk in a very, very precarious situation. So right now, okay, and I'm going to cruise back over to the VIX, there's another strategy that really begs to be discussed. And before I get into that strategy here on the VIX, I also want to show you, as I mentioned a moment ago, if I go over to the trade tab, I'm going to close up this left side bar here, open up the April options. Okay, as I said a moment ago, there was a huge trade that was being done throughout the course of this week, specifically in the VIX, and they were doing it in the April options. Apparently, I am not alone in my quest to buy volatility. Now, before I go any further, I want to make this very, very clear. We know that there happen to be a trader or traders, okay, that are trading massively, just massively in far out of the money options on the VIX. And according to the trades that I looked at, they were definitely on, okay, the buy side of these options. Just because they're buying calls in the VIX does not necessarily, okay, mean that the marketplace is going to tank. There's a number of reasons that a trader might want to buy calls in the VIX. You know, they might want to buy calls in the VIX because they're selling puts in the SPX. They may want to buy calls in the VIX, okay, because they're hideously bearish on the markets. That's fair. They may want to buy calls in the VIX, though, because they're managing $50 billion and they're trying to hedge it. Any way you want to put it, okay, this kind of activity, it really should kind of raise eyebrows at some time. Now, what activity am I talking about? Again, I'm looking at the big open interest in here, but you're like, there's always big open interest. There is. But if I go to the Analyze tab here on thinkorswim, and I just go back to February 25th. I remember it well. It was just this past week. We go back to February 25th. And again, I've elaborated about these trades a little bit in the TheoTrade chat room. Take a look at the volume. Okay. The volume inside of the VIX was considerably larger on February 25th than it was over in the SPX, right? This was a trader that's been absolutely hammering, okay, trades into the VIX. 145,000 contracts, 105,000 contracts, 100,000 lot, 155,000 contracts. They're not done. They were on the put side of it too, okay? Bottom line, massive trades going through in the VIX. Now, with that, the volatility in the VIX, this one trader actually moved the volatility in the VIX itself. If you look, this happens to be, again, specifically, here is February 25th. That was, the volatility went up. It's also how we know whoever was actually trading those calls was most definitively a buyer. They bought so many of them that they moved the volatility in the VIX from 75 back up almost to 80. Think about that. Okay, that's a trader. So we're going to be keeping a close eye on the VVIX because, again, we believe that this is the place, okay, that you want to be in the near term. And as I was, again, elaborating upon, this is lower probability trades. And when I say lower probability trades, stuff like going out there, okay, I'll give you an example. I am long calls in the VIX. I'm not using call spreads, and I'm financing this, okay, via, for instance, selling puts. Now, here's a position where I'm going to sell two puts, okay? Sell two puts in the VIX to turn around. What? If I collect 40 cents a put, I can turn around then and buy something like these 19s. Here, this is selling two to buy one. Now, listen, the VIX might not have bottomed out, but I'm effectively selling two puts of the 1350 variety to turn around and buy a 19 call. It's actually done for a 5-cent credit. But what happens if the VIX completely and totally collapses? Don't worry too much about it. Just go out and buy like a 12 put to hedge off the risk, okay? And this entire strategy all of a sudden becomes defined risk, right? I'm selling a 1350 put. I'm buying what? 12 put. In fact, let me pump this up to 2 contracts, buying a 12 put and turn around then and buying the 19 call. So what am I effectively doing? I am selling this put spread, okay? I'm selling 2 of these put spreads to finance one of the calls. All net, the market's open. This should be done for right around even money. Okay, so this is not like, a wild and crazy strategy. It's a variation of a theme that we believe that these big trading firms are using. Okay, and that gives us sustainability to be long volatility for the next 45 days. And again, that is what I would construe. It's a lower probability trade. Right? And what happens? Well, if the VIX kind of stays around where it is, okay, you're not going to make any money. You're not going to lose any money. If the VIX goes considerably lower, what do you have? A little bit of risk to the downside. Nevertheless, again, this is the kind of strategies that you want to start to substantiate in a marketplace where, you just can't go out and easily, like, what are you going to do? Create an iron condor in the spiders? Okay. The spider volatility, once again, as the marketplace has rallied, that spider volatility has really collapsed back down. And even further out in time, do not put yourself in a precarious position right now. It's already difficult enough as we've rallied up to the upper end of this kind of volatility box. And again, this is going to be the final portion of this video, a little bit of an opinion piece, and that happens to be none other than at the top of the volatility box. What do I specifically expect? Okay, I think we're actually going to break to the upside of the volatility box for the time being. It could be short-lived, and then we're going to get some violent trade right back down. Okay, we'll reassess if we get all the way back down to this 265 over here. Now, a lot of this has to do, there's a ton of catalysts that are coming out that can possibly both spike, okay, and then flip markets back around inside of the next few weeks of trade. Obviously, this the China deal, okay, it's all over the place. Again, economic data all over the place. There is a lot of detachment of the marketplace itself, okay, from the reality of what's going on inside of the economy. All of that, okay, is probably situated around the Fed and Fed talk. I think the Fed, which has been incredibly dovish the last few weeks, I think they're going to slightly alter some of the rhetoric coming into March, having seen this big wicked rally. They're going to maybe take down some of those expectations of being so dovish, which could also have a larger impact on this marketplace. But again, look for the pop to the upside, and you want to be really, really specific of where we think we're going to go. Okay, I think we're actually going to tag this 2842 inside of the S&Ps before reverting back down. And again, if you're short markets, you're going to feel the fear right now to the upside. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.